Hi, welcome everybody. This is our first online installment, and it's my first time to chair Center for Analytical Finance quarterly lecture series. We put those on hold in the fall and the winter to make space for our speaker series on relationship between COVID and finance. And we are very happy to return to our quarterly lecture series. I'm Galina Hale. I'm a co-director of CAFIN with Nirvikar Singh. Today's speaker is Jim Dowd, who is the CEO of North Capital Investment Technology, which is a company that provides technology to facilitate exempt securities offerings by offering compliance tools. He is also founder and CEO of North Capital Private Securities. Jim has 36 years of experience in global financial markets. He held senior positions at a variety of firms and worked all over the world. And in the recent years, he's been at the forefront of financial innovation. And I can't think of a better person to talk to us about the use of blockchain in finance. And I don't want to take any more of your time. Jim, the floor is yours.
Thank you very much, Galina. I appreciate it. I appreciate the opportunity to speak today on the topic of blockchain and finance. And as I was reading through some of the previous abstracts and speaker bios for the Center for Analytical Finance series, I realized that I feel decidedly underqualified to present to you today. I think that Galina must have generously given me some credit for work experience and asking me to speak today. So I hope that I can offer a unique perspective on this topic, blockchain in finance, about which there's already a fairly large and rapidly growing body of academic research, but maybe not so much practical experience in the industry with industry practitioners. As I was putting together my outline and doing some research to kind of provide some context for the work that my firm is doing, I was shocked by the growing volume of different blockchain technology initiatives, not only a wide array of applications in the financial sector, like related to payments and record keeping, but also a broad set of new technical initiatives to help build out or enhance the foundational technology platforms that we kind of describe as blockchain. This is a market map for Bitcoin and blockchain startups in the United States from a couple of years ago. You can see, there's several dozen companies on the map, and you've probably seen similar charts to describe other markets like software as a service companies or cloud computing or cybersecurity startups. This has kind of become a popular way to show online in a graphical way, the number of companies and the different types of activities in a particular ecosystem. But the difference with blockchain is that the startup community is not concentrated in the United States, it's global. And the sheer number of firms and projects in the space is huge. This is the blockchain ecosystem in the UK and Switzerland, Canada, Israel, Singapore, in Berlin. And this list is indicative, it's not comprehensive. There are literally blockchain companies all over the world, and the ecosystem itself is a lot like the blockchain technology, totally distributed and decentralized. And I'll explain what that means and why it's important a little bit later on. I also realized in kind of putting together my remarks that there's no single dominant blockchain leader at this time. There's no Microsoft or Google or Qualcomm or Tesla dominating the industry. In fact, I can't even tell you today exactly how blockchain technology is going to affect the future business of financial services. Which of these firms will succeed or fail, or which ones are even working in the most promising, fertile areas. We just don't know enough yet. It's too early, even though this technology has now existed for almost a decade. But I have a strong belief, and at this point, I think it's a pretty widely shared belief by industry practitioners, that this technology will be transformative for significant parts of the financial system. And so rather than trying to paint a picture of all of the different ways that blockchain technology might affect financial services in the future, I'd like to use my time today to offer you a more personal story as an industry practitioner about my understanding of blockchain technology, why I got excited about it, and how my firm is utilizing it in our business as a securities broker dealer. And I hope that by being able to kind of give you more of a sort of a personal perspective on how we're using it, you can potentially see ways that that technology might be used in other areas in the future. So to start with, what am I referring to when I say blockchain? A lot of people equate blockchain and cryptocurrency, like Bitcoin. But the underlying technology, the technology that creates cryptocurrency and underpins blockchain networks like Bitcoin and Ether, is actually a specialized type of database. And in financial services, these linked data blocks, the blocks that kind of tie the data together, form a ledger that can be used to track transactions and balances. Sometimes this is referred to as distributed ledger technology, and that distributed aspect is very important. But most of you are probably familiar with the concept of a ledger, and you may have heard the term general ledger in an accounting course, or trial balances. These are all records of transactions that essentially allow you to kind of create an audit trail of what's happened in a particular account that you're tracking. And blockchains are used in financial services, or can be used to create ledgers of activity, much like the ledgers in a general ledger accounting system. From a technology standpoint, this is a very unique way of tracking data. So this is a snapshot of a relational database, which is a term that you may be familiar with. This one in particular is an SQL database, and anyone on the call over the age of 50 who has fiddled with databases will probably remember the Northwinds Relational Database. This was a sample database that Microsoft shipped with Microsoft Access and SQL Server going back to the late 80s and early 90s. And as you can tell from the way that this database is laid out, you've got a number of different modules. Each one is called a table. And within each table, there are a number of data fields, and there are a number of records that kind of go into that table. And then the tables are related to each other to provide a system that can be used to store and retrieve data in an application. And in this particular application, the Northwind sample database was set up by Microsoft as an example of how to set up a small business that sells goods. So you've got a table that covers employees, you've got one for orders, you've got one for customers, one for products, and they all relate to each other with key fields that kind of tie the different tables to each other. You also may have heard more recently of a type of database called NoSQL databases that do not utilize these types of relational tables. And these types of databases have become very popular during the past 10 years with the growth of mobile computing, because they're faster and more efficient, easier to access than relational databases. But blockchain databases are a further unique iteration of NoSQL data sets. They're similar to NoSQL data tables, but data records, databases, but they're different. The information that is contained in the data blocks of a blockchain database is securely held in distinct blocks that make up the sequential blocks in a chain. And the way that the blocks are added to this database is completely unique, because the data set is distributed and it's decentralized. So the different participants, the different people who utilize the database, compete for the opportunity to add new data blocks to the chain by solving complex cryptographic mathematical problems. And that's where you get the term cryptocurrency or crypto databases. It comes from the fact that all of these blockchain technologies are basically created through solving cryptographic mathematical problems that enhance the intrinsic security of the blockchain itself. And those participants are rewarded with a fee called a mining fee if they successfully solve the math problem before anyone else and are allowed to add the next data block to the blockchain. So that fee is paid in the cryptocurrency that's tied to the particular blockchain. And there are literally hundreds, if not thousands, of such blockchains. But the two main ones are Bitcoin and Ethereum, which in 2021, everyone is familiar with. In the case of Bitcoin, the actual Bitcoin blockchain today really serves no purpose other than recording Bitcoin transactions between owners of Bitcoin, which itself is a useful purpose because the participants in the Bitcoin blockchain have decided that Bitcoin is a store of value, and a lot of it, over $1.1 trillion of value as of this morning. So this is a fundamental change in the way that a database is created and maintained. And in financial services, where centralization, control points, and trust authorities have for years been critical to maintaining our financial infrastructure and the orderly operation of our financial system, the idea of decentralization of control is a radical, truly radical approach. Instead of having a centralized authority on the left where you have, different pockets of knowledge and oracles of control, you have a system on the right that is truly distributed where all of the network participants are financially incentivized to maintain and secure the database. Now, why is this important? What is the value proposition offered by this new type of database? Well, because the blockchain is decentralized, the very nature of the network eliminates the technical need, and it is a technical need for central authorities and trust authorities, trust providers, many of whom in the past have also been monopolistic rent seekers, entities that exert total control and can effectively set their own prices, or who can exert control over the system, like governments, for example. And so one of the things that one of the attributes of the Bitcoin blockchain that you'll frequently hear Bitcoin enthusiasts talk about is the fact that it can't be controlled by governments. And they view that as an advantage because the blockchain system itself is distributed, and so is control of the system. It's controlled by the participants, not a central authority. And so this metaphor of a walled garden and taking down walled gardens is often used by Bitcoin and blockchain enthusiasts to describe the decentralization that is possible, through this technology. Another value point with blockchain technology is that it is immutable, meaning that the transaction records are added to the chain, and once they are there, they never go away. This is a feature of the technology, and if you are interested or required to maintain an audit trail, if that's important to the underlying technology that you are using, or the underlying application that you're building the technology to support, then it's useful that you have a record of every change made to the data. And blockchains are an effective way of ensuring that you have a tamper-proof audit trail. This is actually a snapshot of what's called the Robston blockchain. It's kind of a test net environment for Ethereum, and you can actually go into either the test net environment or the live net, what's called mainnet for Ethereum, and you can actually see every single transaction that's ever happened in the Ethereum blockchain. And that's pretty powerful when you think about it. If you want to go back 4 years, 5 years, you can see even microtransactions that have taken place. They're in the blockchain as part of the data block. So it's a very powerful kind of system. The next 2 points of value that we see and that you'll see kind of become relevant into our application of blockchain technology don't apply to every blockchain, but apply to the main open blockchains, the open public blockchains like Bitcoin and Ethereum. And the first is open standards. In the case of Ethereum, Bitcoin, and other public blockchains, you can actually go online and read white papers that describe the standards, how the technology is designed to work, what the potential benefits are, and other key attributes of the technology. It's publicly available and you can read about it. And the creators of the blockchain technology want you to understand, what the standards are, and they've provided the standards, and they've provided a mechanism to create and modify standards in the future. The other aspect is that it's open source. And what that means is that the software is free to use by anybody. So if anybody on this call decides today that they want to become an Ethereum programmer and develop technology based on the Ethereum blockchain, they can go to GitHub, which is a repository for software. They can download Solidity, which is a common application used to develop Ethereum applications, and they can start programming smart contracts and or operate a node on the Ethereum blockchain probably by the end of the day. And that's a very powerful value proposition in financial technology, well, in technology generally, but especially in financial technology. So it's the combination of all of these elements, the high security, decentralization, open standards, and open source technology that allows the creation of systems that potentially compete with incumbent financial institutions and their power centers that kind of relate to them, brokers, exchanges, clearing firms. We're back to kind of eliminating the walled garden and creating opportunity for financial innovation. So you might be scratching your head at this point wondering, well, this guy, he's been in financial services for 35, 36 years. He works at a broker dealer. Why would he be interested in changing the status quo? He is the status quo, and you'd be right about that. And there are large parts of the financial system that I don't believe need fixing. I think they work very well, and at least if they do need improvement, it's not going to be with blockchain. They work quite fine, and I don't believe that blockchain technology is going to disrupt every aspect of financial services. For example, I don't believe that blockchain is going to add a lot of material value in transactions of exchange traded public securities, even though this has been a major area of advocacy by some blockchain enthusiasts, especially in light of the GameStop settlement fiasco that occurred earlier this year. There was a lot of talk about shortening the settlement cycle and creating instant settlement and eliminating the ability to short securities in a greater amount than the market cap of the companies and such. And a lot of people, a lot of blockchain enthusiasts came out and said, this is exactly why we need blockchain. This is exactly why we need DeFi to solve these types of problems. And DeFi is a term that is kind of generally used to describe the idea of decentralized finance, usually using blockchain technologies. But I would say that public securities markets, the stocks that you buy and sell on public stock exchange through your broker, generally work quite well. There are low transactions costs, open and transparent pricing, few points of friction. The central clearinghouses, despite the criticism that's been leveled recently, also do, I think, an excellent job. Yes, it takes 2 days to settle a stock trade, but not that long ago, it used to take 5 days. And in some parts of the world, it takes 2 weeks. And the settlement time could be reduced pretty easily and probably will be quite soon with existing infrastructure and traditional databases. And finally, custodians, the brokers and the banks that safekeep assets do a fine job of safekeeping assets. In the past 5 years, there has been far more money lost forever by individuals who have lost or misplaced their cryptocurrency keys than has been lost by US investors over the past 50 years as a result of fraud or as a result of securities being stolen from a registered custodian. And despite the intrinsic security of blockchain as a technology, vast sums have been lost or stolen through fraud, poor technology, security, not related to the blockchain itself, and badly designed procedures. Before Coinbase, which everybody has heard about this week, there was Mt. Gox, which lost 850,000 Bitcoin. That was about $450 million at the time. Today, that Bitcoin is worth $53.5 billion. And that was lost through sloppy security and poorly organized procedures, and amongst allegations of fraud as well. So there are definitely flaws in the current security systems and potentially benefits from blockchain, but I don't think it's going to happen. Blockchain is not going to replace the public market system, and that's not really a need that exists, in my opinion. So what I'm telling you doesn't sound like an enthusiastic endorsement of blockchain. This sounds like the kind of the rants of a incumbent financial professional saying everything is good the way it is. We don't need innovation from this technology. Especially since I told you a few minutes ago that I think the technology is going to be transformative for financial services. So what do I mean by that? And what did I mean by that? So let me explain where we're focusing our time and where we see significant potential. First, the use of blockchain systems to record transactions and disseminate information about securities that are not traded in national public markets. So the whole kind of gamut of securities that don't trade on exchanges and for which there are not liquid, transparent display markets. This is where my firm focuses, and this is where we think there is significant opportunity to create infrastructure where there is none today. This is a $4 trillion market, $4 trillion. And it literally operates by people emailing spreadsheets to each other. The market has not changed very much in the 36 years that I've been involved, and really neither have the spreadsheets. We're still using 40-year-old technology to run a multi-trillion-dollar market. Second of all, the development of self-sovereign identity records, I think, is also an area where blockchain offers tremendous promise, and there's great work being done by firms to create common standards to solve this problem. Imagine being able to encode all of your personal financial information, proof of your identity, how much money you make, the value and composition of your assets, your investment risk profile, your experience, into a standardized private record that you control, and then making certain information available upon request and for a limited time period to the institutions that you are seeking to do business with that might require that information to open an account or process a transaction. Currently, this information resides on the servers of every firm that you have interacted with during the past 7 years, and not always in a secure environment. Remember this? Equifax breach, this is not that long ago. 3-4 years ago, hundreds of millions of records lost to hackers, and a tremendous destruction and loss of trust with private data being leaked out to bad actors. The third application is the use of smart contract technology. And this is actually the area where we believe is the most promise for the application of blockchain in the area of finance that we work in. Private securities, private funds, over-the-counter options. Again, the whole totality of transactions and securities types where there is no existing infrastructure. I believe this is the single most promising application of blockchain in this area of finance. And it is much like the way that TCP/IP allowed for wide area networking to take place, back in the 90s, or the way that HTML technology allowed for the creation of the modern internet. Now, smart contracts are effectively many applications that reside within a blockchain, and the one that's most common for this is the Ethereum blockchain. Was the first to develop this capability and to gain adoption in a fairly broad way. And what it offers is the possibility to automate kind of simple procedures, simple rote procedures with self-executing applications that reside in these open systems and with open standards. And it's very, very powerful. So why has it not been done up to this point? What makes blockchain special in providing this type of application? Well, first of all, common standards, the standards that are required to even allow two different systems to talk to each other and to execute a transaction like that, are very difficult to agree upon. And in my career, I've observed this with the development of the derivatives market back in the 80s. It took a decade to develop a robust set of common documents and language to be able to kind of scale that market. In foreign exchange, which was one of the first markets where electronic trading began to happen, it took years to develop a common standard, the fixed protocol, to develop electronic trading between different firms. The ACAT system, which is a system that's used by broker-dealers to transfer securities from one to another, it still has problems, and not every broker-dealer or custodian is a member of that system. But blockchain systems like Ethereum offer a cookbook for quickly developing standards and rules. And that's been, shown kind of empirically with the development of, market standards very, very quickly. Again, not a definitive market standard, but multiple market standards over a short period of time. Second, the proprietary software that's used to manage many of these banking systems is, it's complex and it's expensive. And so the benefit of having open source software is a tremendous benefit from a cost standpoint. And third, the networks historically have been closed and decentralized. It can take a month just to set up a secure node to be able to access some of these networks, whereas with blockchain, you can get going in an afternoon. So blockchain eliminates each of these three barriers. So I wanted to talk a little bit in the last 5 minutes or so about our blockchain journey, which is unique to our market and our position in the market. We're by no means, kind of a leading firm in blockchain or anything like that. We have found interesting applications, and we see significant applications in the future. But our story, I think, is similar to many firms that have developed a new technology and run into barriers that are non-technical barriers in trying to implement their vision. And for us, it began with a book, specifically this book called Digital Gold, Bitcoin and the Inside Story of the Misfits and Millionaires Trying to Reinvent Money. I read this book at the recommendation of a friend over the Christmas holiday in 2016. And it really, it kind of opened up a totally new, kind of vista for me in terms of how we could utilize blockchain technology to streamline the custody and settlement and secondary trading process related to private securities. We had developed technology to streamline the offering process for private securities, and we become a custodian in 2016. But we were frustrated by the fact that there were no secondary markets for these securities, no easy way to hold them in a brokerage account, no easy way to create communication with other firms or to kind of streamline the process once the initial offering was done. And so we were kind of struggling with this, business problem of how do we, solve this problem from a technology standpoint. And, we were confident that we could solve it for ourselves. But the problem is that financial services are, kind of inherently a network system. You need to have other firms participate in order to really get the type of scale and benefit that that you need in a established, working, well-functioning market. So I read this book over the holidays, and was really interested in the way that Bitcoin had developed, and the way that the market operated autonomously without the requirement for kind of central authorities to manage it. And I started thinking about the idea of Bitcoin as a ledger system, and whether or not we could kind of apply a layer of programming on top of Bitcoin to do the record keeping that we wanted to do for private securities. So we talked amongst our team, and we started playing around with it and talked with my chief technology officer, Anton Prakash, about beginning to do some building with Bitcoin and development. And after about 2 weeks, he came back to me and said, you know, Bitcoin is really interesting, but you should take a look at this technology called Ethereum. It's really designed, it seems like it's designed to do what we want to do. And it has a lot more technical flexibility. So our development team developed a platform, a prototype based on the Ethereum blockchain, and they finished a prototype in about 4 weeks, which is light years in a financial institution of any kind, even a small one. It was remarkable how quickly we were able to develop a working prototype of a functioning decentralized blockchain-based system to track securities. And then in 2017, the summer of 2017, after we had begun to do this prototyping, a report came out by the SEC called the kind of commonly known as the Dowd report, that essentially highlighted the activity that was occurring within the decentralized token blockchain landscape. And it also highlighted what the SEC believed would be sort of the regulatory requirements for entities that were participating in these activities. It also issued some firm warnings to people who were involved in token activities. And some of those warnings were not heeded, and that resulted in future pronouncements down the road. But for the Dowd report actually gave us kind of the starting point for how we could begin to utilize this technology in a compliant way as a registered, regulated institution to make progress in the area that we were working. So we applied to the SEC to become an alternative trading system, an ATS, which is similar to a stock exchange. It's a private market that allows for trading of securities electronically. And then we spent the next 2.5 years refining our plan, engaged with the SEC and with our regulator, FINRA, responding to inquiries, making changes to our plans, building out procedures, developing prototypes, and figuring out how we were going to use that technology. And I'm happy to say today that we obtained permission last year, right before COVID. We began to implement our plan in the fall of last year and develop technologies to be able to do trading and to be able to do clearing and settlement. And over the past 1.5 years or so, there has been a lot of regulatory clarity beginning to emerge. So there was a joint statement on the custody of digital assets that came out in 2019 that provided some clarity about how firms could clear and custody these digital securities. Recently, guidelines were issued regarding the settlement and custody of trades done through ATSs around September of last year. More about the same time, I guess, the OCC, which governs banks and trust companies, suggested that crypto custodians crypto custody could be done through those banks and trust companies. And this year, the SEC has proposed no action relief for special purpose broker dealers. So this is the year, I think, where many of these advancements and much of the regulatory work that's been done is going to come to fruition. There's a lot of fraud and illegal activity that's been flushed out by the regulators, but they've created a pathway where firms like ours and other institutions are beginning to see ways that the technology can be applied in a legally compliant way to begin to realize some of the scale opportunities and the value proposition that's there. So I'd like to kind of conclude with this slide, which I think is actually a very exciting aspect, maybe one of the most promising aspects of blockchain, and also one of the most hopeful aspects of the development that has occurred, which is the idea of interoperability. And the reason why what this slide is it basically talks about the fact that there are people who are developing new technologies to create interoperability between different blockchains. So you have this technology that's a brand new technology, has limited practical uses today, but a lot of potential uses. And already you have firms that are doing innovative work to create innovative interoperability between these blockchains. And the reason why I think this is so important, so promising, and so hopeful is that the industry is already thinking about ways to plan for its own obsolescence. So in traditional technology development, you have a system, you use it for years, sometimes decades, as we do in securities processing. But this is technology that is already figuring out ways to displace itself and to allow for progression to new, better technologies. And so I think that's an incredibly hopeful and exciting aspect that really is kind of central to the work that's been done and is being done. So with that, I'd like to thank you again for the opportunity and open up for questions.
Thank you very much, Jim. That was very clear and super interesting. I learned a lot. So for participants, please type your questions into Q&A if you have them. I'm going to start with some questions that I have. Let me just ask a couple at once, so you can answer them in any order you want. So one thing that I've been thinking about is I'm hearing a lot that adding a block to a Bitcoin chain, for example, is nowadays requires a huge amount of computing resources and therefore a huge amount of energy, which in turn contributes to climate change and things like that. And my understanding is that Ethereum is not as energy expensive, but going forward, do you see that being a constraint on the use of technology if it becomes widespread? And another question is kind of, as an economist, I'm always thinking about incentives. So for people who develop the Ethereum blockchain technology, are they just really want to create a public good by allowing people to create their own blockchains using their technology, or are they actually benefiting in some way every time somebody creates a blockchain using their technology?
Yeah, so those are great questions. So the first one, I think you've highlighted a very real problem today, which is that the largest and most prominent blockchain, Bitcoin, is an energy hog, and it contributes to kind of CO2 emissions through the use of energy, and right now the way that the Bitcoin blockchain is developed, there's not an easy way around that, and Ethereum similarly has that problem today. But Ethereum was designed with a sort of a planned migration pathway that will allow for a less energy consumptive way to expand the block. So you may have heard of the terms proof of work and proof of stake. The proof of work is the calculation of these cryptographic problems and adding blocks to the blockchain based on solving these cryptographic problems. Proof of work has a different approach, and it basically says, well, if we have a big enough blockchain, then we can all agree what the truth is, and we'll decide on what the truth is based on sort of voting rights relative to the value of the network. So if I've contributed historically a lot of work to the network and I have a lot of value embedded in the network, then my incentive to keep the network truthful and accurate is greater than some guy who comes along 6 months from now who maybe has no stake in the network. So the proof of stake kind of ties to this idea that someone that has a stake in the network, that has value embedded in the network, and the collective of all of those people are going to have a powerful incentive to keep that network safe. And in this proof of stake is much less kind of energy consumptive than proof of work. So I think that in the future, blockchains will all migrate towards proof of stake. And you might even see Bitcoin itself move to a proof of stake type environment, perhaps with new technology that essentially takes, the current record as a starting point and then sort of progresses from there. So over the long term, I think that's inevitable. The second question that you had regarding public goods and the idea of incentives, I think is a great one. And one of my favorite economics courses in college was public goods economics, taught by a professor named Henry Briefs, who was this great old kind of guy who would talk about sort of how do you get together to build a bridge, or how do you get together to do something that really no single person might have an incentive to do on their own, but could benefit everybody as a whole. And that's really one of the conundrums with open source technology, right? Like, you build this technology and then you make it available to everybody. How are you going to make any money out of it? How did the individual who made the Netscape browser make money out of the Netscape browser? How did the individual who created Linux, make money from Linux technology? Well, they don't make it from licensing the technology. They make it from their knowledge and from developing systems and capabilities around that technology. In the case of some blockchains, the founders will sometimes participate early in the blockchain and sort of accumulate cryptocurrency related to that blockchain. And then the idea is, if the technology takes off, well, then that value will kind of move up along with it. And the founders of Ethereum are billionaires for that reason, because they were early participants in sort of mining the blocks on the Ethereum blockchain, and then that technology has kind of gathered steam over time. The other thing that's happening is that the technology, the wealth that's been created from cryptocurrency, in many cases has been reinvested into the ecosystem. So a lot of the reason why you see so much innovation happening and so many new companies being formed is that people who have made vast amounts of wealth from cryptocurrency have plowed that wealth back into the ecosystem because they're true believers. They really believe, in many cases, it's been validated that this technology is really transformative in different segments.
Can I ask a clarifying question? So if I want to create a blockchain just for the purposes of recording transactions that are not, contracts or something like that, that do not necessarily relate to immediate transfer of valuable assets, I don't know, for tracking my students' grades or something like this, right? Does there have to be a cryptocurrency associated with a blockchain, or can there be a blockchain without a currency? And it also relates to a question from Ashok Vaish in Q&A. Since there is a significant cost to create a block, can peer-to-peer transactions be frictionless, and so we can transfer 5 cents to each other for free?
Yeah, so for most of the blockchains that I'm familiar with, the technology sort of assumes that there's a process by which a block gets created, and the financial incentive to have the decentralized participants create the blocks, is the payment of that financial reward. So there are ways to bring down the transactions costs, and this is a topic of a great deal of conversation, right now with Ethereum, that the cost of recording transactions has ballooned over the past few years. And so there are different protocols that have been developed, side chains and roll-ups, which basically take transactions off of mainnet and then kind of consolidate them and then record them back into the main blockchain at a time when there's less peak activity. So it's kind of like, it's like if you live in Phoenix and you use your air conditioner in the middle of the day, you're going to be incurring, really high energy costs because everybody's using their air conditioner at that time. If there were a way to kind of store up power and then sort of, use energy more evenly across the 24 hours, the costs go down. That's a sort of the same idea with some of these strategies that are being used with Ethereum. But it's also true that if you wanted to set up the Galena chain, you could take open source technology from the internet for Ethereum or any number of other blockchain protocols and create your own private chain. And in fact, there are many people that have done that. I personally believe that if you're talking about financial services specifically, then a lot of the benefits that you get from having open standards, open source, decentralized participation, those kind of go away, and you might as well just set up a, kind of a NoSQL database at Amazon Web Services, and you'll get sort of better performance and and better documentation. But it is possible.
Thank you. We have a couple more questions, so I'm going to group the questions from Manish Shalat and Kenneth Garges. So Manish Shalat is asking, so the Chairman Powell is talking about cryptocurrency as very volatile substitute for gold rather than the dollar. And so the question is, what do you see as the future of a cryptocurrency, let's say 5 years from now, with how it relates to software infrastructure, currency supply, authority control, and as a digital asset? And adding to that, Kenneth Garges is asking, what do you think about the expiration dates on cryptocurrency? Because it's been mentioned in relation with China's stablecoin.
Right. So I think it's important to distinguish cryptocurrencies as a value, as a store of value, or as a medium of exchange, and blockchain technology is a technology that can be used in all manner of different applications. And I'm not an expert on cryptocurrency. I'm at best I'm an enthusiast in terms of watching, kind of what's happening, and sometimes with horror. But the interesting thing is, the description or the comparison to gold, I think, is an interesting one, because what is gold at the end of the day? It's a shiny metal, right? It doesn't have a huge amount of practical industrial application. It's just that for historical reasons, it's viewed as a store of value, and so people, when they worry about how to store their value, gold is a better store of value than other things. And it's can be transported, and it's compact, and et cetera. Bitcoin is sort of similar in that regard. I mean, it has no intrinsic value. The value derives from the fact that there are people who own it who think it has value, and other people who want to buy it who think it has value. And so it's similar to a fiat currency in that regard, except that the control of the supply is not governed by a central trust authority. It's controlled by the network itself. So I believe that there is a lot of enthusiasm and a lot of interest in sort of economic models where there's a view that the supply can be trusted. Where there's a lack of trust in centralized institutions, there's a concern that the Fed can just print money, and we may become more like kind of a not well managed government, printing money and depreciating the value of money. That can't happen with cryptocurrency, because the creation of the cryptocurrency is controlled programmatically and is embedded in the code itself. But so I think that there will be continuing reasons and probably expansions of cryptocurrencies, but I don't know. I don't know or have a good idea about whether or not they'll increase in value, whether or not they'll proliferate. I mean, again, you could create your own Bitcoin network tomorrow, but what gives Bitcoin its value is the fact that it is broadly decentralized, widely utilized, and now has a track record going back 10 years. I think the other aspect is that Bitcoin blockchain is a tracker, is a measure, is a ledger for real assets, whether those assets are metals, property, stocks. I think that's going to grow, and I think that there are, for the reasons that we got attracted to blockchain technology, I believe there are going to be segments where where that gains acceptance in it and adds a lot of value. And one of the examples, a group that we work with is doing a lot of work with property records in Africa, where there, you have fewer trust authorities, the records are not great. In many cases, there's corruption. There's a need in a situation like that for an immutable, transparent, decentralized record keeping system. And so in an application like that, blockchain, automatically adds more integrity to the system because you're not relying on potentially corrupt central authorities. In an environment where there's less corruption, and where there is already a high degree of trust, maybe the application is kind of less important.
That's a great prompt to the next two questions, actually. So Todd Feldman is asking, can you see major financial institutions using Ethereum as a main infrastructure going forward to conduct their financial transactions because they will benefit in terms of the savings that you mentioned, that you wouldn't have to use proprietary applications and software? And as a result of that, Eric Fisher is asking, would companies like title insurance industry, for example, would they have to worry about being driven out of business by the blockchain technology?
Yeah, that's a great question. I mean, and that question is oftentimes asked in the context of intermediaries like ours. We're a broker dealer, we're a custodian, we operate an ATS. You can envision an ecosystem where none of those things are required. Where everybody has self-sovereign control over their information, over their assets. You keep your assets in your wallet. But I personally am not especially worried about that. I mean, first of all, because of the complexity. There's a tremendous amount of complexity in even applying the technology, and I think it will take decades before that's even a possibility where you don't need intermediaries, at least to help you utilize the technology. I think the second thing with respect to the kind of the store of value and the use of trusted providers is that a lot of people don't want the responsibility of controlling assets and tracking keys and that. I mean, I think everyone has probably seen headlines of the guy in San Francisco who has 2 opportunities left to guess the password on his crypto wallet, and there's $350 million sitting in that wallet, and he can't access it because he forgot the password, and he doesn't, and so who wants to deal with that? I mean, you want to be able to call your broker, and if your broker goes out of business, you ideally you'd like the government to be able to step in with an insurance program or something to kind of provide that trust verification. So I think that we're a long ways away from having a completely decentralized system, and I think human nature is such that at least I for one am never going to want that. As you get older, you start to forget things. So probably crypto keys would probably be one of the first things that I would forget. The first question was kind of related to Ethereum as a platform for institutional financial institutions. I think there are potential barriers in terms of the kind of the institutions themselves being reluctant to use a public blockchain in that way, particularly for a primary record. But there's also a lot of resistance from the regulators, and I think actually with good reason. There's a concern, and this has come up in conversations that we've had, that if decentralization can be a positive and a negative. On the positive side, there's not a requirement for a central trust authority that can be a monopolistic rent seeker or a kind of an overly controlling influence. On the negative side, it's possible to envision what's called a 51% attack, where bad actors get control over a network and sort of rewrite history. And I don't think that the regulators are going to permit substantial portions of the U.S. financial system to be exposed to that type of risk, and nor should they. Now, as these technologies become more well established, I think that you can again bifurcate the technology aspects from, the particular networks. And I think you'll see, multiple, applications of Ethereum blockchain technology, and maybe open and sort of quasi-public applications, but with some control points to make sure that, that the system maintains integrity. And one of the examples I always use is, this problem of immutability can be a positive or a negative. I mean, it's positive in the sense that you have an audit trail, but it could be a negative. What happens if somebody publishes a lot of confidential information into the blockchain and you can't get it out? And so now that information is out there forever for everyone to see. That's a negative aspect of blockchains. And I could foresee situations where something like that could cause the government to shut down the network, because the risk of having the network is greater than the benefits of the network. And so those are the types of, I think, philosophical and technical issues that people need to think about.
So we only have a couple of minutes left, but I wanted to ask you one more question, just kind of thinking in this philosophical dimension or about all these costs and benefits. If you were able to ask the regulators for what you would need for this technology to go forward, in the work that you do, what kind of regulation would you like to see coming from, a variety, I understand that the system is very complex with SEC and OCC, and, some cryptocurrencies are viewed as, as assets and some are viewed as commodities. And so what would make your life easier in this business?
Yeah, that's a great question. I mean, I wish I had sort of a wish list. But I guess, practically speaking, I've kind of learned to live with low expectations and sort of hope for the best and plan for the worst. I think the regulators have done a pretty good job in the US of kind of allowing firms to begin to chart pathways to commercial success. So I guess when I'm, kind of in my Eeyore mood and sort of, down on the process and expressing frustration, it's that it's difficult to get clarity in certain issues. And obviously it would be much easier for us to, kind of move forward from a business standpoint with clarity and with, kind of certainty about certain areas. But as I said, kind of during my remarks, I think that the regulators are starting to provide that clarity. I mean, they've issued a series of pronouncements, and they don't kind of give you a roadmap that says exactly this is how we're going to regulate these things. But anybody that's been in the industry for a while can kind of read between the lines and sort of identify what's going to be permitted, what's not going to be permitted, what the regulators are concerned about. And I think in a lot of cases, their concerns are very valid, and in a lot of cases have already been borne out by the activity in the market. So the SEC is very concerned about investor protection. You don't have to look very far to see that there's been a lot of fraud in the space, and the SEC has cracked down on that. That I think makes it kind of important to ensure that if you're planning to utilize this technology, that you put investor protection front and center in your plans and sort of plan accordingly. Nobody wants to get a phone call from the widow of somebody who has the family's net worth locked up in a private wallet without access to crypto keys. I mean, imagine being the person to take that call. So I think I guess I don't have any specific asks for the regulators. I think continuing to provide clarity and maybe creating sandbox environments for people to do testing and to kind of prove out some of these ideas in practice would be helpful. But I think it's moving in that direction.
Great. On that note, I would like to thank all the participants and thank Jim for giving a super interesting talk. And I would like to thank Johnny White, Diana Hogue, and Stella Yee for making this talk possible. And I hope to see you all in the fall.
Thank
you.